The inflation roller coaster just took another turn because yesterday we got the latest inflation data, and what it said is that inflation is now at 3.4%, which came in at expectations, and Wall Street loved it. Now you might say, well, Jaspreet, if the inflation data comes in at expectations, why is everybody so excited about it? Why did the S&P 500 break a brand new high? Why did the NASDAQ break a brand new high? The reason why Wall Street was so excited when we got this at expectation inflation number was because when we got the January inflation number, 2024, it came in hotter than expected. When we got the February inflation number, 2024, it came in hotter than expected. When we got the March inflation number, 2024, it came in, you guessed it, hotter than expected. And now when we just got the inflation numbers for April that came in at expectations, everyone says, finally, a breath of fresh air when it comes to inflation. And so what I want to do today is go over what's going on with inflation. I want to go over number one, where did we see the high inflation versus the low inflation? Number two is I want to go over what does this mean when it comes to interest rates and the Federal Reserve Bank. Number three is what does this mean for the stock market in the near future? Number four, what does this mean for the housing market? And then number five, what does this mean for the economy? Now, a couple things. I know this video looks a little bit different. It's because I'm recording this off of my phone so we can get this data in real time. And again, right around the corner, May 21st at 8 p.m. Eastern Time, I'm hosting a live stock market investing workshop. It's completely free. If you have money in a 401k or an IRA, or you want to learn how you can invest in individual companies and find undervalued companies, this is a free workshop. You don't want to miss out on this. There's going to be so much value given. There's not a recording. This is a live workshop. So if you'd like to join me, I got the link for you to register down in the description below. So now, jumping into where was inflation the hottest and where was inflation not? Let me start with where was inflation the hottest. Inflation came in the hottest with car insurance prices. Over the last year, car insurance prices have jumped up by around 22.6%. That is the highest growth in car insurance prices in more than 4 decades, about 47 years, since we've seen car insurance prices jump that high, that fast. Number two, we have rent prices, which came in at 5.7%. Number three is housing costs, not rental costs, which came at 4.7%. Then we have restaurant fees. We all know they're going to expensive restaurants. It's getting even more expensive. Well, that's coming in at 4.2%. And guess what? That also includes non-expensive restaurants, which are also getting more expensive. And then finally, we have earnings, your incomes. The reported earning growth, according to the CPI data, the inflation data, is 4.1%. And that got Wall Street and the White House very expected, because if earnings came in at 4.1%, but the average inflation was 3.4%, that means, according to this data, that people are making more money now relative to inflation than a year ago. So people have more money to save, more money to spend, more money to shop today than a year ago, according to the data. Now, if you feel that way, I would love to hear from you. Let me know in the comments. If you don't feel that way, also let me know in the comments. I would love to hear your thoughts on this. But we also got some good news from this inflation data. The good news is the prices of some things have fallen. What are those things? Egg prices are down 9% over the year. Rental car prices are down 8.8% for the year. Flight prices, airline prices are down 7.1% for the year. Used car prices are down 2.2% for the year. And new car prices are down 0.1% for the year. And now this brings me to part two, which is what does this mean for interest rates? Because the Federal Reserve Bank is going to be meeting on June 11th and 12th to discuss what they want to do with interest rates. Do they want to keep interest rates where they are? Do they want to cut interest rates? Or maybe are they even thinking about raising interest rates? Well, in the most recent Federal Reserve Bank meeting, what the Federal Reserve Bank and Jerome Powell, who's the chairman of the Federal Reserve Bank, said is that they don't want to cut interest rates until they see inflation steady at 2%, or at least on target for 2%. Well, for 2024, what we saw is that in January, February, March, inflation was going up. Then in April, inflation kind of came in at expectations. It did fall a little bit, but it's still quite a bit of a way from the 2% target. Not to mention that the Federal Reserve Bank doesn't like to look at this headline inflation, CPI, which is what all the news agencies cover. They like to look at what's called core inflation. Core inflation is when you take this headline inflation and then you strip out what the Federal Reserve Bank calls the volatile numbers, which include energy and gas. I know everybody needs energy and gas, but the Federal Reserve Bank doesn't like to look at those numbers. And according to core inflation data, core inflation fell to 3.5%, which is still quite a bit away from the 2% target. So when we talk about interest rates being cut, what you have to understand is this is just one piece of data, and the Federal Reserve Bank wants to see a trend closer to 2%. Now, as soon as this inflation data came out, one of the reasons why you saw this big move in the stock market is you have a lot of traders who are hoping that now, because we're finally seeing this, we'll call it breathing room in inflation, if you want to call it that. A lot of traders are not hoping that this means that we could see rate cuts sooner rather than later. When will they actually come? Well, everybody's holding their breath. We'll see what happens. But this is where now, when it comes to interest rate cuts, just understand that the Federal Reserve Bank has so far said that they want to wait and see, and we will wait and see. We're still quite a bit of a way from 2%, so we will wait and see. The next point that I want to go over is, what does this mean for the stock market? Because obviously we saw the S&P 500 break a record high, the NASDAQ broke a record high, the Dow Jones is even at a record high. So what does this mean for what's going on in the stock market? And what you want to understand here when it comes to the stock market is that the stock market is a place where investors put their money based off of what they think is going to happen in the economy. The stock market and the economy don't move linearly. They can move in different directions, especially in the short term, because this is where people put their money based off of what they think will happen in the economy. And when we have these moves with inflation, when inflation comes in, we'll call it at expectations. I can't even say lower than expectations because it was right at expectations. When inflation comes in at expectations, well, this got a lot of people on Wall Street excited because it's finally not above expectations. So even though we have these expectations for inflation, everybody's kind of thinking that inflation is going to come in hotter than expectations. And because of that, people are hoping that inflation will be on a downward trend. And if inflation comes on a downward trend, that means that the Federal Reserve Bank could start cutting interest rates. If the Federal Reserve Bank starts cutting interest rates, that could make buying a home cheaper. It can make buying a car cheaper. It can make your credit card debt cheaper. It can make your business loans cheaper. It can make commercial loans cheaper, which could help stimulate the economy. And so you have some traders hoping that these interest rate cuts will happen, which is why they're dumping money into the economy. But what you want to understand is that short-term moves are short-term moves. And if you are an investor, you have to make sure that you can cut through the noise and understand what's really happening in the big picture in the economy, because, well, that's how you make your money as an investor, not as a trader. And this is where you also want to understand that in the stock market, you're not just buying a stock. I mean, you're actually buying a company. And the reason why this is so important for you to remember is because companies are impacted by interest rates, because most companies on the stock market have debt. And the companies on the stock market that have debt don't have a 30-year fixed rate mortgage. They have readjusting mortgages. And most companies that have debt readjusted their debt back in 2020 and 2021, where interest rates were at their lowest levels ever. So now, as these debts start to readjust, because these aren't 30-year fixed rate mortgages, they're 3-year, 4-year, 5-year, maybe 7-year loans, these debts are now starting to readjust. If they're going to readjust at the higher interest rates, that means businesses are going to have to pay much higher debt servicing costs. And if they have the money to pay it, great. But if they don't have the money to pay it, that could be a problem for businesses in the future, meaning in the next 12 to 18 months, if they have to pay these higher costs and they don't have the revenue to support it. So you want to understand that you're not just investing in a ticker symbol, you're investing in a company. And if you're investing in stocks, you definitely want to understand what's happening with the stock. That way you can make smart investing decisions. That's one of the things that we're going to go over on my Stock Market Mastery Workshop. The next thing that I want to go over was, what does this mean for real estate? Now, the obvious part here is people will say, if the Federal Reserve Bank doesn't cut interest rates right now, then that doesn't do anything with the housing market because the mortgage rates are not going to change. But that's not true, because there are two factors that affect mortgage rates. You have the Federal Reserve Bank interest rate, and then you have what's called Treasury yields. And Treasury yields are the interest rate that you get if you lend your money to the government. Now, put yourself in the bank's shoes. If you're a bank and you have money sitting that you want to lend out, that you want to invest, because banks invest their money by lending it out, you compare your options. You compare your cousin Bunty, that is not good with his money, that is a risk. And then you have your other options, which are this person who's a very good creditor, who's very good at paying their bills, who's very good at making their payments on time. And then you have the United States government. Who do you think the bank would want the lowest return from? The United States government. Because, well, the United States government can print money through the help of the Federal Reserve Bank, and they have tax dollars from the entire country. So if now the treasury yields, the interest rate that the government is paying out, are going up. Well, that means they're going to charge you and your cousin Bunty more money. And so this is where now you want to understand what's going on with treasury yields. And what we saw happen is as soon as we got this inflation data that came in at expectations, the treasury yields fell a little bit because investors who invested in these treasury yields got a little bit of a sigh of relief saying, maybe this is a good sign for inflation. If it's a good sign for inflation, it's a good sign for the dollar. If it's a good sign for the dollar, it's a good sign for the economy, which means they needed less treasury returns. And so if treasury yields fall, that's good news in terms of mortgage rates coming down. Now, it's not anything drastic, but that kind of gives you an idea of what helps move mortgage rates day to day because the Federal Reserve Bank isn't changing interest rates day to day. So if you want to get an idea of where mortgage rates are going to be going, pay attention to treasury yields, particularly the 10-year treasury yield, and that'll give you an idea of where mortgage rates are going because if the 10-year treasury yield is rising, you can expect your mortgage rates to rise. If the 10-year treasury yield is falling, well, you can expect your mortgage rates to fall as well. The next thing that I want to go over, finally, is what does this mean for the economy? Now, there's a couple different parts of the economy that you want to understand. The first part is the consumer side of the economy, and the second part is the business side of the economy. And the reason that I want to separate these is because when you have high inflation, that hurts consumers. And who is a consumer? Everybody. Rich people, middle class people, poor people. Everybody is a consumer because everybody's got to eat, everybody needs clothes, everybody needs a place to live, everybody needs a car. Well, not everybody needs a car, but a lot of people need a car. Everybody's a consumer. So when you have high inflation, that hurts consumption because that means you have to pay more money for things. Now, obviously, some consumers are hurt more than others because if you're a consumer that relies on your salary and you're not getting any raises, well, now this inflation hurts you a lot more than somebody who is a big-time investor who has seen big returns over the last few years and has seen their wealth double, triple, or quadruple in just the last few years. And so now if you see 5% inflation, that doesn't bother you as much as somebody who doesn't have a raise. And what we've been seeing happen is that for the average person who relies on their salary, their incomes are not growing fast enough to keep up with inflation. Now you might say, but Jaspreet, the data says something else. The data says 4.1% growth in earnings, 3.4% inflation. That means the data says that people are making more money relative to inflation. And sure, that's what this data says, but you got to also remember that this data doesn't always give you the full picture. Because at the same time, we're also seeing more and more people go into credit card debt, more and more people are digging into their savings, more and more people are pulling money out of the 401ks, more and more people are saving less money because they can't save as much money because they have to pay more money for their rent, they have to pay more money for their groceries, and they have to pay more money for their car. And so what we've seen is that generally more and more Americans are starting, not a huge kind of drastic cutback yet, but we are seeing some Americans now starting to cut back on their spending, which hurts the ability for some businesses to make money because if you're not spending money at Chipotle, Chipotle doesn't like that. And then if we flip the script and take a look at what's going on with corporations, well, corporations are also impacted through this data. Now, they're impacted through this data in a couple of different ways, just like consumers. Well, inflation also hurts corporations in certain ways because that means their costs also go up. Now, corporations have to pay fees to run their business, right? They have to pay a cost. And this is called the Producer Price Index. This is the measure of inflation, which shows the inflation that businesses are facing because businesses have to pay fees to get their raw materials, to pay their labor, to run their businesses. And this Producer Price Index still shows us that inflation is still around for businesses. But the other part that I want you to understand when it comes to businesses is the debt part, which I kind of highlighted a little bit earlier. But corporations are still sitting on huge piles of debt. And if that debt is in a non-income producing asset and that debt starts to readjust, that's going to hurt more businesses. Now you're going to say, what does that mean? Well, if you remember back in 2020 and 2021, we saw this huge boom in stock buybacks. Now, if you were an investor in a stock that was doing a stock buyback, it was great news for you because you saw your stock values rise. But what we also saw during that time was leveraged stock buybacks really skyrocket. A leveraged stock buyback is when a company goes into debt so they have cash to buy back their stock. Now you're going to say, Jaspreet, why would a company do that? Because if you can borrow money at, let's just say 3%, and now you can borrow hundreds of millions or billions of dollars, Now use this money to go out and buy back your own stock, and your stock value goes up by 4 or 5%. It's kind of like arbitrage. But the problem now is some of these companies have spent all this debt. They had very low payments, which wasn't a big deal because they were making enough money to support those payments, but now this debt is going to be coming due. 2024, 2025, 2026, this debt is going to be coming due. And if that money is already spent, on your stock buyback, well, that money is not producing you an income, because when you use that money on a stock buyback, it's not an income producing thing, right? It's a thing to help boost the value of a company in the short term, but it doesn't actually produce any real value for the company. It increases the implied value, the stock value, but it doesn't increase how much actual value that you provide as a company. And so this is going to be an issue as companies who did these stock buybacks, the leveraged stock buybacks particularly, and don't have the revenue to continue supporting the higher debt costs. And that's why you really want to pay attention to interest rates, because that can impact many different phases of the economy. Because now if a company doesn't have the ability to continue making the higher costs because of inflation, and then the higher debt costs because of interest rates, that's going to be a problem. And we're just starting to see the impacts of the higher debt costs. 2024 is kind of like the real beginning of the readjusting phase. We're going to see more in 2025 and again more in 2026. But if interest rates stay high, that means that the cost for businesses to do business who have debt is also going to be high. And if they run into a situation where their costs are a lot higher and their profit margins start to shrink, then these businesses are going to have to make adjustments. And what does an adjustment mean for a business? Well, adjustments mean maybe layoffs, maybe cutting down divisions, or finding other ways to make more money. And so this is where you want to pay attention to what's going on here, because inflation impacts the economy in many different ways. It impacts people's ability to spend. It impacts what's going to happen with interest rates. Interest rates impact what happened to businesses. It impacts people's ability to spend, and all these things impact the broader economy. And that's why you have to be a financially educated investor and not just rely on one piece of data and just look at one side of the argument to understand what's happening. You have to kind of look at the broader picture. That way you can make smarter decisions as an investor. Now, of course, we keep you updated on market briefs. I do my best to keep you updated here, but this is where it really helps to understand what's going on. That way you can make smarter decisions with your money and find good investment opportunities, because all these things create opportunities for the people that are financially educated. So with that, I'll see you in the next one, and hopefully I'll see you on my Stock Market Mastery Workshop as well.